All right, let's talk about your retirement savings. You're at a crossroads, really, with a huge decision to make. Do you play it safe with the steady, protected path, or do you go for the ambitious climb, hoping for bigger growth? Today, we're going to break down fixed index and variable annuities to help you figure out which path is right for you.
So you've spent years, maybe decades, building up that nest egg. And now comes the big question, right? Do you wrap it in bubble wrap and protect it from every little market tremor? Or do you put it to work, risking the climb for a shot at even greater returns? This is the fundamental choice we're digging into. What we're really talking about are two totally different philosophies for your money. One is all about safety and security. The other, it's all about growth and potential. Let's meet the two contenders in this financial face-off. To make this easier, let's give these two a personality. On one side, we have the fixed index annuity, the FIA. Let's call this one the steady guardian. Its main job, its whole purpose is to protect. And on the other side, we've got the variable annuity, or VA. This is our ambitious climber, always reaching for that higher peak. So what exactly is this steady guardian? Well, an FIA is built from the ground up to protect your principal. You literally can't lose your initial investment to market downturns. Now, its growth is linked to a market index, something like the S&P 500, but, and this is key, there's a limit, a cap. So if the market goes up, say, 10%, but your cap is 6%, well, 6% is what you get. You get a nice slice of the upside with zero of the downside risk. And our ambitious climber, the variable annuity goes all in and invests your money directly into the market through things called subaccounts, which are a lot like mutual funds. The goal here is much higher, uncapped returns. But, and this is a huge but, there is absolutely no safety net. Your principal is fully at risk. When the market goes down, your account value goes down right along with it. Okay, so we've met the players. Now let's really get into it and put them head to head. This is where you'll start to see the core trade-offs you're making with each of these choices. This table just lays it all out, doesn't it? It's so clear. With the FIA, see that? Principal protected, but earnings are capped. That means lower risk. Then look at the VA. Earnings are totally uncapped, but your principal is at risk. That means much higher risk. And notice that last row? Fees. That's a huge difference we're about to get into. Let's really hammer this point home. Principal protection. With the FIA, our guardian, your initial investment is secure. The market could have a terrible year, and your principal is safe. Period. With the VA, you're riding the market wave, for better or for worse. There's no guarantee, and your account value can and will fall. Okay, but what about the fun part? Making money, right? The potential for growth? This is the real trade-off. The FIA gives you that link to the market, but that growth is capped. It's designed for a steady but limited journey. Our climber, the VA, has no cap. The sky is the limit. You have the potential for huge gains, but also for huge losses. You're getting the full, unfiltered market experience. So it all boils down to risk, doesn't it? How much can you stomach? The FIA is, by its very nature, a lower risk product. It's for people who put safety first, who just can't stand the thought of losing that hard-earned principal. The VA is higher risk, no question. Its value is going to swing with the market's moods, making it a better fit for folks who are comfortable with that kind of volatility. And now we have to talk about the cost of admission. FIAs usually have lower fees, which is great, but you do have to watch for things that can limit your gains. But with VIAs, oh boy, it can be like a layer cake of fees. You've got your administrative fees, fees for the investment managers, and then these mortality and expense charges, they can seriously eat into your returns over time if you're not careful. Okay, enough about the mechanics. Let's talk about you. As we go through this next part, I want you to ask yourself, which one of these sounds like me? This is that aha moment, that moment of self-recognition where you match the product to your own personality and what you want for your future. So, are you a steady guardian at heart? Does this sound like you? Protecting your principal is your number one non-negotiable priority. You're okay with a ceiling on your gains because that peace of mind is priceless. You like predictability, lower fees, and honestly, you just want a calmer ride into retirement. Or are you more of an ambitious climber? A VA might be your thing if you're chasing that stock market level growth. You get that the market has ups and downs, and you can handle it. You also understand that higher growth potential often comes with higher fees, and you might even be interested in some of those optional add-ons called riders that can guarantee an income stream for an extra cost. Okay, I bet you have a leaning by now, so let's lock it in by laying out the pros and cons of each one in a really clear, balanced way.
Remember, no financial product is perfect. It is all about picking the set of trade-offs you can live with. Looking at the FIA, the pros are pretty powerful. Your money's safe, the fees are generally lower, and the income can be really predictable. But the cons? You're going to have some serious FOMO when the market is soaring and you're hitting your cap. You also don't get any stock dividends, and your money can be tied up for a while because of surrender charges.
Now for the VA. The pros are definitely flashy. Uncapped growth, you're in the driver's seat, customizing your investments. The cons, though, are just as big. Those higher fees can be a real drag on your returns, you're taking on all the market's risk, and frankly, these products can be super complex to really wrap your head around.
All right, no matter which way you're leaning, I want to give you some practical money-saving tips. Think of this as the how to be smart about it section, because there are ways to make sure you're getting the most value and not overpaying.
Okay, listen up, because this is super important. Number 1, don't pay for fancy add-ons, those riders, if you don't actually need them. They cost you. 2, if you're already in a high-fee annuity, look into a 1035 exchange. It's a way to switch to a better one without getting hit with a big tax bill right now. 3, pay attention to that surrender period. Make sure it lines up with when you think you'll need the money. And finally, number 4, know how much you can take out each year for free. It's usually about 10%, so you can get some cash without paying a penalty.
You know, at the end of the day, it really all comes down to this great quote from Sean Plummer, a retirement planning pro. He says, choosing between a fixed index annuity and a variable annuity comes down to how you feel about risk, fees, and consistency. That just nails it, doesn't it? Risk, fees, consistency. So that leaves you with one final question. It's the most important one. When you're thinking about your future, what matters more for your peace of mind? Is it knowing your principal is protected no matter what? Or is it the thrill of having unlimited potential? Your answer to that question, that will show you the right path to take.